Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hi guys, this is Justin. In this episode of Excess Returns, Jack and I have the privilege to sit down with John Montgomery, founder and CIO of Bridgeway Capital Management. Bridgeway has been running model-driven investment strategies since 1993, but that's not the only thing that makes the firm unique. From giving back to attracting the best people to thinking long-term, John explains how the firm delivers and builds on Bridgeway's mission. Then we get into investing and talk to John about factors, his contrarian mindset, and Bridgeway's core investment criteria and their focus on discipline and consistency. Thank you for listening. We hope you enjoy this discussion with Bridgeway Capital's John Montgomery. John, thank you so much for joining us today.
Thank you for having me. It's good to be here, Justin.
We're going to talk a lot of investing today, but before we do, I wanted to start by asking you about the unique way Bridgeway operates as a company. You give a portion of your profits to charity, you cap your compensation of the highest employee according to your stewardship commitment, and you have a policy of making all employees long-term owners of the company. So these are very different things than you would typically see maybe from a Wall Street firm or other large asset management companies. So maybe to start, I just wanted to ask you, what led you to set up the firm in this way?
Well, right off the bat, Justin, one thing I'll do is there are probably a half dozen or more other interesting aspects of our culture and things you mentioned. But one of them is we don't use the word employee at Bridgeway. Words are important, and we think about our values and how we use words. And the derivation of the word employee comes from French background, meaning used. So the employer is the person that's using the employee. And I like to say, anytime you're willing to talk about your fellow workers here as somebody you're using, then I'm comfortable with using employee. Otherwise, we default to the term partner, or more generically, colleague in that. But that's just an example of how important we feel culture is. So how did you ask the question, how did I make the decision to go a different direction from Wall Street? Well, first of all, I didn't come from Wall Street, so it wasn't very hard to just start from scratch. Another aspect of that was it's unusual to start a company in a business where you've never worked before. Transportation was my previous profession, and the commonality of that was numbers and statistics, which is thus how you get a statistically driven, evidence-based firm called Bridgeway. But it's also, at some level, easier than that. Just started thinking about, first of all, we're managing money as an investment advisory firm, and it attracts people who are aggressive with financial goals, is what I would say. And my wife and I had already achieved the level of, we could say, the American dream that we aspired to. So money wasn't really the next thing on our list. Our goals weren't very high from the career that I had started before, and we got married when we were 21. So those just weren't the top things on our list. But purpose in life was, and I thought, if you're going to start a company from scratch, think of everything that's gone in your career up to that point in a different direction. And when you start a new company, you get a chance to create it from scratch. You don't have to do all those things. So one of them was creating a great place to work. If you're going to spend all this time at a place, you want to do that. And we get awards as a great place to work. Our clients come first. And so integrity is our number one business value. We think a lot about how you can differentiate yourself and, frankly, have a lot more fun in life. And the third aspect of that is community. So those are the three C's: clients, colleagues, and community. And, those were just some early ideas. Money wasn't first. I'm a member of an organization called the Tugboat Institute, and they say profits are not the end goal, but they're the fuel. So purpose, whatever your purpose is, that's the end goal. Profits are key to get there. They're the fuel of how you do so. So we don't poo-poo profits. They're important. And we're an investment advisory firm. We certainly look at profits of the organizations that we're purchasing.
You had mentioned on a interview with Barry Ritholtz that, some of the unique structure of Bridgeway have benefited you as a firm. So can you maybe just talk to some of the benefits that you've gotten over time with the unique structure that you just explained?
Sure. So a couple of, several things come to mind, really. And if you stick with the three C's there, one is if you have an empowering group of people that you work with, our partnership, that's going to lead to good things. We aspire to long-term relationships, and then you can pour yourself by way of relationship and resources and training into the people that you hire, and that benefits the business in any number of obvious ways, by way of longevity, by way of positive engagement, by way of really seriously trying to do what's in the best interest of, we say, our current investors. So that would certainly be one. The giving back half is probably the most strange one, because you think, well, if you're giving half away, then you've got half left over. And that's actually what I thought at the very beginning of founding Bridgeway as well. It's like, well, we won't be as tempted by just what money can buy and all the stuff, because life's really about relationships and things that are more important. And at the end of a decade at Bridgeway, I thought, shoot, this didn't work at all. The half that we've got left over is much bigger than the full pie that we would have had we started out in a very different way. And I promise you, if more business people could get inside my head and see the reality of that statement, there would be a lot more generous giving companies in our culture and nation.
So the giving half, you started that on day one?
Yes.
That was a founding? Amazing. Wow. What's your selection criteria for the charities that you support? Is there something specific you like to look for, or?
Yes. Well, part of our vision, written on our mission statement, is a bit unusual for an investment advisory firm. Our clients and what we're about and changing the world internally is a piece of that as well. But the lead-in that's quite different is a world without genocide. Part of our purpose, literally, for being on the face of the earth and doing what we do, is to end genocide. So that's a key, a uniting effort in our giving back and our philanthropy. But it goes broader than that as well. Not everybody, like I do, wakes up in the morning, puts their feet on the floor, and goes like, let's go, work on ending another war. People have different things that inspire them, and we try and identify those and support each other at Bridgeway to do those. So among the partners that I work with, education is very important to many of us, if not most of us here at Bridgeway, and we do several things by way of education locally and nationally. Microfinance is a point of connection for a lot of people for probably obvious reasons. If you're dealing in finance, then empowering people and figuring out how to, I had a friend that used to say, what you really have to be careful about is not doing more damage than good as you're trying to help people. So we think about sustainability, we think about empowering rather than disempowering as we're working. And it's also not just about money there. We engage with our labor. We go out together as a team and do stuff in the community, connected with our annual retreat. I serve on a couple of boards, nonprofit boards outside of Bridgeway, and we mix it up and learn from each other and are inspired by that. You can take any partner at Bridgeway, ask them, what lights them up and what are they doing and what are they about and how does it connect with the giving program at Bridgeway, and they'll have their own inspiring story to tell.
We talk to a lot of quantitative investors on the podcast, and one of the things that's always the most interesting for me is sort of how they got there. What in the beginning of their investment career, what led them to adopt the quantitative approach versus what a lot of people do, which is thinking they can pick stocks. And I'm wondering if there's anything for you that sort of made you go towards a quantitative approach to investing.
Yes. So two things. One, just most generally, I'm an engineer. I love to fix things. And, science and statistics and empirical evidence is part of my background and thoroughly ingrained in kind of a worldview. Apart from that, I have two advanced degrees. So I have an engineering degree, a master's from MIT. So that's the part that relates to what I just said. And then I went back to school about 5 years later and got an MBA from Harvard Business School. So I'm at Harvard Business School, and I'm in a different industry. But I thought, well, I'll take a few investing courses while I'm here, and maybe earn back the opportunity cost of having taken 2 years off to go to business school. That was my thought. So it's kind of an large this will be kind of a sideline but interesting thing to do. So I'm in one of those investing courses, second year. And it's a class on a quant. And so there's numbers and statistics in investing, and I'm fascinated. I was like, oh, I didn't know you could do this. I thought, you interviewed management and you did the historic CFA deal, and, you had a view on the economy and then, industry and then companies and all this stuff. I grew up the same way. But I'm in this class, I'm exposed to this. At the end of the class, the professor steps back and he strokes his beard and he goes like, so how many people in this class think when they get out of Harvard Business School and go to Wall Street, because most of those classmates did, could beat this track record? And I'm looking around the room and 80% of the hands go up. Now, I'm already familiar with the 80-20 rule. I'm going like, I didn't know the degree to which is true, but after costs, it's the other way around. 80% of the hands go up. And it's not because these are arrogant people. They're actually, more down to earth than I thought before going there. It's simply that they're used to succeeding. They have a view of, their own talent and being able to ferret this out. And that's the normal model of bright people doing investments. And the thought that jumped into my mind was, if that's true, if 80% of the people think they can beat the market and only 20% of the people say can, that's an opportunity for quantitative methods. You should be able to come in with the discipline of data and quantitative methods. Today we'd say, AI in there somewhere. But that's a big advantage. And this was an insight from, 35 years ago. But it was a quantitative and a behavioral finance insight before I knew what behavioral finance was. So that started me thinking about how to apply quantitative methods. That's what lit me up. And I'd say that was, a point in time that set me on a path to doing what we do, how we do at Bridgeway.
It's interesting because that overconfidence sort of plays into every part of life. If you ask people if you're an above average driver, I think the numbers are something like 90% of people think they're an above average driver. So I think it sort of carries to every aspect of our lives, and it can obviously be really dangerous in investing.
The Lake Wobegon effect, I believe, for sure. But you're right. That aspect is part of it. The other psychological aspect that's key, I think, to investing is the tools that you use that work in many areas of your life get you off track in investing. And that works like this. We call it the behavior gap, a term coined by Carl Richards, which is normally, like you're buying a refrigerator, you go out, you do reviews, you find out what's good. You get this in, you ask your friends, you do research on the company, and then you go out and buy a great refrigerator. You do that with a stock, and the problem is managements can pull the wool over your eyes. You have a natural tendency to buy what's done outrageously well right now and then hold it too long. That's a momentum. Momentum's a fast moving. But it's not a great way to buy stock and hold on to it for 5 or 10 years. So what works in one area of life actually gets you in trouble in investing.
That sort of leads right into my next question, which is there are many approaches to investing that are being utilized today that are not necessarily based on long-term evidence of what works. And you guys had an interesting phrase on your website that talked about your approach, and you talked about it having an evidence-based worldview. And I'm wondering if you could just talk a little bit about what that means in terms of how you build portfolios and how you manage money.
Well, at Bridgeway, I like to say from a quantitative standpoint, we believe in two things, a risk-based view, but also a behavioral based worldview. So we believe in numbers and statistics and modeling and all of the good and also hard things about using statistics. The good things are the discipline, the ability to go back in history and see how things have actually worked. And the downside is data mining. That's public enemy number one of how we do what we do. So we're always guarding against data mining. We have, half dozen ways to try and guard against it. One of our team members, the director of research, is amazing at this. Like, he is so good and so allergic to aspects of data mining. That's helpful to have on the team for sure. But another member of our team, Kailu, likes to say, the problem is the only true out of sample, which is one way we avoid data mining. The only true out of sample is called the future. So, that's a fair statement. And people, there's a lot of recent, talk about factors of size and quality. And if you take size, for example, we like to say, well, yes, it goes through long periods of being out of favor, but our true out of sample called the future is the entire 23-year track record of our ultra small company market fund, so very small companies, and it's done quite well over that full period.
One of the things when we started running, we run some quantitative strategies ourselves, and when we first started doing it, one of the things we did is we built strategies for ourselves. And so I'm a very risk-tolerant investor. I love the high-factor exposure, really focused portfolio. And then we put those out in the real world and we realize, nobody can actually stick with these things. These things deviate so much from the market that our investors just aren't able to handle that. And I'm wondering how you look at that balance, the balance between getting factor exposure in your strategies, but also thinking about, all right, can people in the real world actually follow these? Because the most aggressive strategies, almost nobody can actually follow those.
Yeah. Well, I wouldn't say almost nobody, but you're right. And that has been our experience at Bridgeway. Personally, I have a very high tolerance for what we would think of as short-term risk. I really do have a long-term view. I have a static target asset allocation that always has me rebalancing back into what's done most poorly recently. And it's true, though, and by the way, this is not just retail. This is not just your average individual investor out there. This is true of pension funds and foundations and consultants. There's not a lot of appetite for not hugging the benchmark. And of course, that's gotten much, much worse or much more strong in the last decade and two with the advent and huge growth of passive investing and indexing. The indexes are a big deal. Of course, the advantage there is low cost, and you have to be willing to put up with returns that don't track that index. So in a quarter, in a year, even for multi-year periods of time, if you have a very disciplined strategy, whether it's quantitative or not, you've got there are fewer people that are really up for that. So I think it's a point well taken. We have some strategies that recognize that, and other ones that are kind of the same as they were 27 years ago at Bridgeway, and some of them just don't care about tracking error of the benchmark.
One of the things we talked about with Jim O'Shaughnessy when he was on the podcast is this whole idea of that investors have 2 points of failure, which gets at the point you were talking about, which is one point of failure is when the market's down, they're going to panic and they're going to sell. And the second is when they're underperforming, they're going to panic and they're going to sell. And, as I've done this for a while, and I want to see if you agree with this, I tend to think the second one might be a bigger problem than the first one. Like it's almost harder to watch people around you making money while you're not than it is to actually lose money while everybody else is losing money. I mean, what do you think about that?
So the disposition effect would say that the downside is more painful than the upside. So I think there might be something there. But your point is right on target overall. Like it's Carl Richards refers to it as the cycle of fear and greed. When things are going great, you think, oh, how did I miss that? I need to get in. I need to get in. And on the other hand, then you get in and it reverts to the mean and you go like, oh no, it's down, X%. Why did I ever think that this was a good idea? So you sell and chase the next hot thing. There's good research that says even if you buy at the top of something, but hold on to it long term, you tend to do very well. I like to say have a static asset allocation, write it down, stick to it, always rebalance back to the target, which forces you to turn the behavior gap that you mentioned on its head.
In looking at the strategies that you run, it seems like there's three sort of themes that play a role in the selection process: the company financial health, price momentum, and also some value metrics, I think, come in there. But before we want to talk through each of those with you, but before we get into that, could you maybe just at a higher level walk us through your overall portfolio construction process and I guess your philosophy in terms of building these systematic portfolios?
Yes. So we have two groups of strategies at Bridgeway. Called Omni and Select, and they work a little bit different. Omni is where we're just trying to capture aspects of some unique asset class put together in an unusual way. So one of our long-term strategies is our blue chip fund, and it's non-market cap weighted, very large cap, we call ultra large cap strategy. So we're just trying to give you exposure to that, and in return, you get a very low expense ratio. And that's an example of one of our Omni funds. We've got an Omni fund that's on the other end of the size spectrum. We call our ultra small company market fund. So we have some tilts, but mostly with those strategies, we're just trying to give you exposure to whatever the name of the strategy says, and we do it in ways that are thoughtful, and sometimes there's no one else out there doing it. So you won't find many non-market cap weighted, very passive strategies like our blue chip. And then on the other hand, we're a small company, so the big guys are too big to offer a truly small cap, ultra small cap strategy. Those are both on the Omni side. I think of equal interest is what we call Select. And that's where we had these three groupings that you speak of: value, momentum, company financial health. And the key aspect, two of them, there are more, but two key aspects of the portfolio construction there are that we're always rebalancing to target weights of those three categories. And again, that forces you to always be adding more money into what's done poorly and taking money away from what's done well. And over the long term, that has both some key positive risk characteristics. It also tends to tilt your overall portfolio construction toward value, which we like. That's been seriously out of favor the last 5 years. But long term, we know that that's one of the granddaddies of factor investing. So we like that from a portfolio construction. So rebalancing back to target weights of those three categories. And then likewise, I'm not a fan of market cap weighting overall. It's a momentum type strategy without a rebalance. So something goes up and up and up, and you ride it up, and then it crashes, and you crash right down with it. It's also got aspects of non-diversification that we don't like. So Apple makes up a huge percent of the total market capitalization right now. I remember when funds were filing to become non-diversified funds back in 1999 because Microsoft was getting to be too huge a piece of the pie. I mean, this is an S&P 500 index fund filing to be a non-diversified fund. Stop and think about that for just a second. There's a red flag in there somewhere. So those are two aspects of our portfolio construction: the rebalancing and the non-market cap weighting.
let's peel back the onion a little bit on a value. Some investors, some quant investors have a specific value factor they use, while others might use something like a composite approach, so multiple value factors. So how do you, how do you think about, I guess, value and the best way to define it and capture it when building these types of strategies?
We're a fan of multi-metric aspects of any factor. So our director of research completed a project a couple of years ago, and we've got a thought piece out on it just on that aspect. And he used value as the factor to look at. You could look at other factors and come up with a very similar conclusion, but it was dramatic because he went back to the full FAMA French or the Ken French library of factors with respect to, I think there were 3 or 4 different metrics of value. And price to book is the academic gold standard of thinking about value. So you can look at how that performed over the long term and in decade by decade. And then he went back and took just a plain vanilla equal weighted 4 different measures of value, like price to sales, price to earnings, and added those in. When you add them in, what you learn is that it does a little bit better over time, but the risk aspects are like noticeably better. So you get a little bit of maybe on return. Any one year, one of those 4 metrics is obviously going to be the leader versus the average. So you'll never be at the top, but you'll never be at the bottom. And it gives you a less bumpy ride along the way. And Jack, I think back to your earlier point, a less bumpy road is good for keeping people in a strategy.
Quality is probably one factor that most investors find difficult to sometimes define. And it seems like when you're referring to your company financial health sort of category or criteria, at least in part, I think you're referring to a quality factor. So just in general, what types of metrics are you looking at when you're trying to find those quality or financially healthy companies?
Well, I agree with your point. There is a gold standard of measuring value. There's not really a gold standard of measuring quality. It's harder to get your head around. Like, we all think we know what it means, right? You go to the stores, like, that one's a piece of garbage and this one's high quality. And you might be able to find the same for a stock, but it's much more difficult to quantify. But we look at a number of classical measures and some combinations that are proprietary. But things like return on equity would be one. There are interesting aspects of return on assets, which has some different flavor to it. Debt to different metrics of debt. I like debt to market capitalization versus debt to equity, for example. What you include in the numerator and the denominator makes a difference. How quickly you update your data makes a difference. There are a lot of things around the periphery where you can add or subtract value. But I am a fan for those. In the company financial health category overall, it does correlate strongly with quality, so I'd agree with your statement, Justin. Other things that we might look at would be earnings, might be earnings trends, could be quality of those earnings themselves, measured in some different ways. Some things that are in, some people put in the sentiment category. That's another category that gets defined a lot of different ways. But you can put most of these things under a quality banner, and if you run it through a regression analysis with one or more of these classic definitions of value, then our company financial health tends to bend that direction.
Momentum is one that is in many ways is the simplest factor, because it's just about buying things that have gone up, maybe in an intermediate term period. But behind the scenes, there's usually a lot more going on than that. And I'm wondering if you could talk a little bit about how you guys think about momentum.
Well, we think about price momentum, and we think about it in different time periods. So most classically, momentum works particularly well in, then, say, a 3 to 6 month period, maybe stretch it out to aspects with 12 months. a 1 month period of momentum is actually upside down. So you need to be careful about the very short term. However, there are some even shorter ones that if you hold them long enough, behave back like we think about momentum. These are things that are documented in academic studies. Before we would actually use any of them, we always replicate the research ourselves and say, do we agree? Are there any mistakes in the research, and how would you fold it in? So price momentum is big. There are disadvantages of price momentum. Momentum crashes is, the classic ones. We also know that there's a flavor of down market in the last decade, which was not true in the market prior to the 2008 downturn. And momentum models are in particular susceptible to those. So these are, it gives you a flavor for, numbers and statistics is what we do. We look at different market environments. Anything we do, we want to know how it is likely to, or at least historically, how it has performed, so that you're not surprised. And then the futures, our director of research says the future is not going to replicate history, but it rhymes. So that's how we think about it.
One of the things we found in studying successful investors over the long term like you is there typically is always a period somewhere in their history where either they had a big mistake they made or they went through a period where they underperformed for a while, and sort of how they came back from that and what they learned from that ended up being very important in their long-term success. And I know you focus a lot on your mistakes and learning from them at Bridgeway. I think I read somewhere you have a mistake wall where you put up your mistakes, and you mention them often in your client letter. And I'm wondering if you could just talk about maybe some mistakes you've made in the past or some periods where you've struggled and maybe what you've learned from them that's, helped you become the investor you are today.
Definitely. Like, I've lived long enough to make some mistakes, and not surprising as an engineer, I like to document those and not repeat them. We actually have a mistakes ball at Bridgeway. It's a baseball in a little plastic case, and we pass it on to the newest partner that comes into Bridgeway that we hire. And what we say about this, like, it's physical, you see it, you think about it. The idea is that we are going to make mistakes, and if we're going to achieve what's written on our mission statement, you've got to take some risks. But you want to manage those risks, and you don't want to repeat them. You absolutely want to learn from them. So I'm a big believer in the learning from mistakes, but also not hitting people over the head for making them, because that's a great way to end up with people who are very conservative and end up with all kinds of problems like the buy high, sell low syndrome that we were talking about before. So Jack, help me get back to your specific question within that, though.
I was just wondering if there was a significant mistake in your own career or a period where maybe your strategy struggled that you learned a lot from.
Yeah, so a specific one. A good example would be penny stocks in 2009. Okay, so we have this strategy of very small companies we call ultra small. So it's the ultra small company market fund, and it's invested in companies the size of the smallest 10% in the New York Stock Exchange. One of the things that our primary market benchmark, the CRISP 10 cap-weighted portfolio index, that's a mouthful, does is they're not going to tend to own penny stocks. If you have a stock that goes below $1 and you can't adjust for capital reasons, then you get booted off an exchange after a period of time, and then you're delisted and you're not part of the index anymore. So we thought, well, this is an interesting aspect. How have penny stocks done over the long term? And it turns out, in round numbers, penny stocks adjusted for everything else underperform the market by about a 0.5 percentage point a year. Well, that's big enough to get our attention. And so in this strategy, you could have, you come up along, you get penny stocks from time to time. And it's a sidestep. Like, we don't invest in penny stocks partly because they're not in the index because of this delisting rule. But we were doing this, and in 2009, what happened was the market crashed. You get a lot of small companies that become much, much smaller companies. Their price dips below 1, And we suspended the penny stock rule. So we stopped selling, but we still weren't buying significant numbers of these penny stocks. In 2009, at the peak, penny stocks made up 11% of our primary market benchmark in companies this small. 11% is a big number. Typically, it was like 2.5%. In the crash, it zooms up to 11%. It's not part of our direct process. We didn't track these before. In 2009, what do you think the average return of a penny stock in this index was?
It had to be huge, I would imagine.
It was 286%.
Wow.
So, like, if you didn't own a handful of them in the index that goes up that much, you're going to lag the index. And it caused our strategy to lag by double digits in the year. Like, it was a big number, all on the backs of this one thing. What I learned from that is if there's a factor exposure, especially one that's not directly part of your process, be aware of it, track it, and be aware of when it gets to be a bigger piece of the pie. So in March, fast forward in March of 2020, not quite a year ago, the market goes way down with the pandemic. Our ultra small company market goes way down, and all of a sudden there are penny stocks everywhere in the index. So we stopped, it was like, pause. We remember 2009. We're tracking penny stocks now. And we asked the question, what's the percentage of penny stocks in the index today? It was 16%. That had not been true in 90 years of the index. So that gets your attention. And what's the risk? Well, we'd lived through it before, so now we knew what the risk was. And we have an investment process of balancing back toward the index when something is way out of whack like that. So we're actively adding penny stocks to the strategy. By the way, they're obviously less liquid, so you have to work harder at this until we get it back up to the index level. No, we're not making a bet on penny stocks, right? We're not. That's not the purpose of the strategy. But you hug the index when something goes haywire and out of focus, and that has helped tremendously in the performance of the strategy since then. So a learning for me is, if there's something that's not a part of your process that can affect your returns, make sure you're tracking that as well.
That's really interesting. I also wanted to ask you about the importance of disagreement. I'm a big value guy, and one of the things I did early in my career is I just surrounded myself with other value guys, and so they could just tell me that I was right. And I've sort of learned as time's gone by that that's probably not the best way to do it. And in other interviews, you've talked about how important disagreement is in Bridgeway's approach. And so I was wondering if you could talk a little bit about that and how you incorporate that into how you operate and you manage your portfolios.
Well, in terms of the dynamics of the team, I guess is where it's most clear. We believe in diversity, diversification at a portfolio level, diversity in terms of the people that you have in the room with you for exactly the reasons that you mentioned. If you're just listening to people that think like you do, you're in a silo, and you can look at our country and the politics and see the problems of doing that. So I'm a huge believer in dialogue. Bridgeway has a whole program that we call servant leadership, of listening, not going up a ladder of assumptions. We have learning partners. So you measure, there are tests you can take to get cognitive diversity. I'm paired up with a person at Bridgeway who is most unlike me in terms of how he makes decisions. And we drive each other nuts for obvious reasons. But we are absolutely 100% committed to the relationship because we learn from each other. And when he shows up in my space and he says, John, he's usually, we're always respectful. That's another aspect of the diversity. I like the phrase, we're respecting all people, all of the time, no exceptions. That last part is rough. Like, that's a very high standard. But if you're serious about that, you get more of the benefit of diversity on the team. So we're looking for people that you respect, who are, highly skilled, who don't agree with you, and you want more of that on the team. The person that I've worked most long on the face of the earth is Elena on our investment management team, an amazing leader. And Like our minds do not work the same way, but we love being with each other because we're always learning from each other. And if it's a project management things, like I'm not going to override her opinion or her decision on something because I know she's good at this. She's much better than me. And if I show up and say, I've had this thought and it's an intuitive thought, but I think we should listen to, like, she's going to stop, even though she's like really driven by numbers and statistics. Like, okay, John's asking me to suspend this again. But she's going to listen and see, is there a truth underneath that? And I think that's great for any team, any thought process, and it certainly and especially includes investment.
John, sometimes when we're talking about quantitative models and this type of investing, people often think that these things just like run on autopilot and just kind of develop themselves. But the reality of it is that, behind each investment strategy, there's a thoughtful person or team that's making decisions and testing various different types of strategies and factors. So I wanted just to ask you, maybe give us an example or two of how your process has evolved over time. When we had, going back to the interview with Jim O'Shaughnessy, and I'm sure you're familiar with his book, What Works on Wall Street, O'Shaughnessy's strategies have sort of evolved over time as we've gotten more data on things and as he's looked at different metrics. So I'm just wondering from Bridgeway's perspective, like, how have your strategies evolved and what does it take to change a strategy?
Well, there are both sides of that. So I'd say, front and center and higher up is the discipline of having a process and following the process. And since we're statistically driven, evidence-based, we do the research, we do the modeling, we write that down, we document it, and then, then you get to, by the way, 90% of research goes in the trash can, and we celebrate that. It's not everything you think of. And by the way, there's a bias not to do that among quants, right? You don't want to do all this work and then just throw it in the trash can. That's a bias that we have. So we celebrate the ones that go in the trash can just as well as the ones that we implement. But things do evolve over time in the process. I would, but the basic core hasn't changed squat since the beginning 28 years ago. We're still focused on the numbers. Things that are different are my views on risk. I used to think like everything was driven by risk, and you could track that exactly. And the thing that threw me off was the low vol effect. It's like we're taking kind of the textbook academic measure of low risk and high risk by standard deviation of returns, let's say, and if you believe in risk, I'm thinking like, okay, so high risk you should be rewarded more for, and that means that it should do well over the long term with a lot more volatility in the short term, and the reverse. And it turns out that's not the case. Likewise, beta, low beta outperforms. So I had to come to terms with the data speaking to me in different ways than what I grew up with and what I believe. So what about that? Well, the human tendency is to block all that information out. Like once you've decided how the world works, very strong human tendency is look for information that corroborates what your opinion and keep away the data that doesn't. We're always straining. We're human, like we've got a pulse, but we're always straining to do the opposite of that. So now I'm a believer in behavioral finance as well as the risk view, and it incorporates some of this, and it complicates things. But that would be a change in our process, that we're more open to non-risk-based factors and strategies and things that affect trading. And some of this, would fall under supply and demand. We have interesting recent experience in the marketplace with GameStop and what I call the Robinhood stocks on that. You can look at this as supply and demand. It all lines up pretty nicely. And you can guess, the directions of what's going to happen when things are this far out of favor, but you're probably not going to get the timing right. Don't ever think that you'll nail the top or the bottom. And that's something that I would say our process has more specifically recognizes than in the beginning. When you're 40 or 30 and you look at a certain amount of data, you think that's a lifetime of data, and it is, but it's still not long enough. And I like to think there's always one more standard deviation of out of favor you can get. So at the end of 2019, large cap value stocks had been out of favor relative to growth stocks as measured by the Russell 1000 indices of each. In round numbers, 10% a year, 3 years in a row. Those are very large numbers. And you could say, well, it's obvious value is going to come back, and so I'm going to, leverage value. And you would have been wiped out in 2020 because that was a 30+% year of growth outperforming value. So there's always one more standard deviation than you have, and don't ever think that you can time it. But it does mean from a risk standpoint, we always look like, okay, this may be really cheap, or it may be really something that we measure statistically, but what would one more standard deviation do relative to what you've got in your database?
Good. Thank you for that. That's the next question I want to ask you is related to value. And to your point, up until maybe just even a few months ago, value had struggled a lot. And there's different narratives as to why that might be. Some people basically say, the Fed and the interest rates has been bad for value because they're so low, or that, the value premium might not be as robust because too many people are, using it or in their process, or maybe intangibles have, affected sort of value. So I'm just wondering, and I'm not making you make a timing call here on value, but, how do you, when you think of what has happened in values relative underperformance, let's say over the past 5 to 10 years, what do you think of that? And do you have any outlook for the future of value stocks, let's say over the next, 3 to 5 years? Again, not a timing call, but just want to hear your thoughts on that.
You asked about 5 questions, and I've got an answer to every single one of them. But Justin, before I end, you're going to have to bring me back to some of the specific ones. The big view on this is that I'm a contrarian at heart. We've already mentioned, we have some momentum models. So those are we invest in a diversified way in momentum, which is kind of the other side of the coin from value. But I'm most happy when everyone else is wringing their hands. So I love value stocks right now. There's this is unbelievable. This is amazing. I'm the guy who in 2009, after a crash, is hopping around the room going this is awesome. Stocks are so cheap. We can buy many more shares with the same amount of money. And I ask people, I ask investors so you've saved up and you invested, let's say you have $100,000 in stocks and you're new to this. And you're sitting there at age 30, let's say, looking forward. Let me ask you a simple question. Do you, right now, today, do you want the stock market to go up or do you want it to go down? There are many gray answers in finance. There are many, you can do it this way. There's a right and a wrong answer to this question. As long as you're still saving, investing, in other words, as long as you're in your income producing year, the definitive correct answer to this question is you want the market to go down as far as it can, as fast as it can, for as long as it can, as long as you still have a job, so that you can continue to invest at cheap. Now, the day you retire or the day you need to pull it out to invest money in a house, or that day you want it to be the opposite of that. But until then, you should celebrate every day that it goes down. That's true with factors as well. We're always rebalancing back to the mean. So all else being the same for today, I'd rather it be cheap while I'm adding more in. So I love this. I'm also human. And so, I like to, shareholders have more positive comments about you when things are going up. I feel that part. I feel that part as well. Justin, you had a couple more specific questions in there, though. I want to make sure I don't get away from them.
Yeah, no, I think you hit the nail on the head there. It was really just maybe your outlook I think you answered the question. I mean, I think you're bullish on sort of value stocks
Yes.
because of the fact that they have, relatively underperformed over a very long period of time. And that's, yeah. So you did answer the question. Thank you.
Let me just say, so we're sitting here in mid-February of 2021. As of right now, size and value both have been very, very far out of favor. And like that's when like I'm rebalancing, making more commitments to this. In the last 3 months, through from beginning of November until now, size has come roaring back. So you have all these articles like the size effect is dead, or maybe it was never there. And I've read every academic and industry article I can get my hands on this. And it's fascinating to see how people put this together. So some really good research too, by the way. I won't go into the details of that unless you want me to. But just to say, in the last relatively short time, they've come roaring back. The truly small end of the spectrum, not what passes for small, but truly small, has come roaring back. And they've still got farther to run as we measure it. So they're not expensive yet. They were left behind for a whole blasted decade, and they were really cheap. And so now they're not quite so cheap, but they're still on the good side. However, so he's like, is it too late to have gotten into that? It's like, well, 3 months ago would have been better. But you're never going to time that exactly right. And I would say they're still on the cheap end of the spectrum. Value, however, has not come roaring back. Value had a nice blip in November, and year to date so far, it's kind of just flat. It's gone back and forth. And you break that down, but as an overall statement, value is just flat, and to me, it's the 100-year storm. Like we are that far. Once in a lifetime, you get value this cheap. And we're still sitting on a point in time. That doesn't unfortunately mean it's not going to get cheaper. It just doesn't mean that. You just can't time these things. And believe me, I tried. Like I would like to be able to do so. We've done a pile of research on that. As far back as 1985, I did research on this, and Bridgeway has expanded it and replicated it twice, including a few years ago. And so there are things you can do with moderating risk, but you have to be very careful. And I'm also a huge believer in don't use leverage. The beautiful thing about stocks is you can get them in over the long haul. They're just an amazing growth machine that anybody at even very low amounts of money can invest in. But you got to be willing to ride it out. And if you borrow money to buy stocks, you get cashed out, and you're cashed out at just the wrong time, right? So I'm a believer in stocks for the long term, diversification, low cost, manage all that stuff. But then have a plan, write it down, stick with it, and those principles will serve you very well.
It's interesting because you touched on this already, but there's this tendency. I'm like you. I look at value and I'm like, this is going to be if I look out 10 years, this is a great opportunity in value, and so I got to add exposure to it. But then when you get behind the scenes in the data and you look at it and you say, all right, well, I also thought it was great in 2018. I was pretty excited about value, and so the actual implementation of this factor timing is way, way harder than it seems. And so it seems like from your answer, you guys don't try to say, let's overweight a factor like value just because it's out of favor. Is that right?
As a rule, that's correct. There are some minor exceptions to that, but as a rule, that's correct. I like to, again, have a target allocation and rebalance back to it. By the way, if you own an S&P 500 index fund today, you're hugely overweighted in growth. If you start, with two equal pieces, and this one goes up 20% and this one goes up 150%, which do you think you own more of? That's true inside an index as well. So I advise people, if you really want to balance back to a long-term historical average, you should be owning more of a value index fund than a growth index fund, or, consider a strategy that really focuses on that.
For my last question, I want to ask you about risk. And you've touched on this a little bit before, but it's such a hard thing to measure in the real world. Obviously those of us that are quants have our standard deviation and our other ratios, but there's a lot more to it, especially when you bring in the fact that a lot of risk is tied to the behavior of the actual investors that are following your strategy. So I was wondering if you could talk a little bit about, at a high level, how you view risk and how you look at it when you build portfolios.
We think of, from a quantitative standpoint, we think of there's a return dial and a risk dial over here. Now that's a simplification, but fully half of the exercise is around risk. So a couple of things. Organizationally, we do some things there. For example, we have the investment team. I reflect our view on how we use risk measures to design and implement and track and do performance attribution for a strategy. Organizationally, and then diversity of cognitive ability on the team, so you have different people. We have a quarterly exercise, for example, that we'll be doing next week on is there any risk factor that is true based on what's going on in the marketplace that we're not focused on, that we're not thinking about. So, like there's a change in administration. Is that going to do something in a predictable way? The Fed would be a great example. Interest rates are really low. Are they going to go negative? Probably not. You can't say definitely not because it's happened in another Western country, but it's probably, it can't be very negative, right? Like people aren't going to pay you a whole lot of money to stick this money under your mattress. So we say this is an unusual time. Interest rates have a huge upside and very little downside. And when you can make statements like that, like make sure that your strategies aren't positioned in some way that would blow you out of the water, and manage that risk. Right now, high dividend yield stocks are the deal. If you believe that there's significant upside potential for interest rates, people have replaced fixed income because interest rates are so low with high yielding stocks. And we can prove statistically these have been bid way up and they're much riskier than they used to be. People think of high yield stocks as safe. Historically, they have been. Today, they're not. It's not. If that's a variable that's not in a strategy and a model for us, we don't override the portfolio strategy, but we'll hug the index on that metric. So we're tracking every strategy at Bridgeway and saying, are there any where where the yield is creeping up above its benchmark? And if the answer to that is yes, then we look at zero cost ways of bringing it back to the benchmark. So that's how we think about risk on the team. Organizationally, there's also a committee at Bridgeway called the Portfolio Innovation and Risk Committee, who independently of the investment team is looking at all this stuff. They're there to, it's cross-team. There are people from marketing. There's the president of the company, myself as a CIO, and a head of the committee that's independent. And it's to look over the shoulder at the investment team and our strategies and to say, are we behaving? Are the strategies behaving like in accordance with design? Are we doing what we say? Are there any red flags in either the performance looking back or exposures looking forward? That's part of their job, and I'm proud that we pay that much attention to risk because people are paying us to do so.
John, before we wrap up, I just want to say I appreciate the comments you made about investing for the long run in stocks for the long run, because I think that it's just very important to emphasize long-term investing when investing in the stock market. And so that coupled with, I think your I guess it's your view or your humbleness, if you will, that you know that the future is kind of unpredictable, and we don't know if, even though value stocks look cheap, I mean, it doesn't mean that they can't get cheaper, and that this idea that looking at maybe historical data is the end all be all. It's not how investing is, and you just never know with investing. But if you think long term, dollar cost average, do the things that can build wealth, that time is probably on most people's sides. And so I just think a lot of what you were saying and you sprinkled in there is really, really good. thoughts and views. So with that, thank you for sharing your thoughts and wisdom with us today. It's Friday afternoon. We'll let you kind of get on with the weekend, hopefully. And where can people go to learn more about Bridgeway, the strategies, your research, and what you guys are doing over there?
Bridgeway.com would be a great place to start, Justin. Thanks.
You're welcome. Thanks for joining us, John. We appreciate it.
Thank you, John.
Okay, thank you. Appreciate it, gentlemen. Have a good weekend.
You too.
Bye-bye.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.